Good day, fellow investors. This is likely the most important video I have made over the last 6 years because it will comprise practically everything you need to know when it comes to bringing your wealth from here to a higher level. Of course, we'll discuss a recent Mark Spitznagel interview and some other content that I have found, like this interview with him, that discusses the current market, the economy, the Fed's distractional activity, the likely apocalyptic crash that will happen because of what the Fed is doing now, the core principles of investing that are not diversification, the holy grail, Dalio's lie, but something much more easier to understand. We'll discuss also the biggest investing risk and how to protect yourself from that, how to invest in this crazy environment. It will be a longer video. Devote your time to it. Take a cup of tea, cup of coffee, enjoy it, write down notes, and then really think about whether your wealth will increase over the next decade, 2 decades, no matter what happens. Without watching this video, this is what your investing strategy looks like. Now, to start, just a bit on Mark Spitznagel, author of the Tao of Capital. We have it there, and Safe Haven just behind the Chinese version of my book, Modern Value Investing. My book is a 2, his books are a 10. So that's how much I think of his books and his way of thinking that nobody likes. Because I was really surprised to see that after 2 weeks, his interview on YouTube got just 2,800 views. If I say something, I get 2,000 views in a few hours, and that is crazy how YouTube works and also what is the focus of people. But further on, Spitznagel, he is the one running Universa, and when the market crashed in March 2020, I think they did 3,612% in 1 quarter. Of course, what they do is investment insurance, where you give them 2% of your portfolio so that when a crash happens, they make 3,000% in a quarter, and then you have the dry powder to invest after that crash. That's the strategy. That's also the strategy that he promotes as the way to compound capital at a higher rate, which should be the risk mitigation goal over time. All we'll discuss in a moment. But let's immediately start with his views on the current market. He's predicting an apocalyptic crash, but let's see. The first thing might be very surprising. He's saying that we should have 1 or 2 legs up before we see something bad. And that's likely on the Fed lowering rates like everyone expects. Even Spitznagel expects lower rates. As interest rates go down, stocks go up. That's how things work. The first sight of tightening, people were scared a little bit. The market went down 25%, but now it's clear that higher rates cannot be sustained for longer. Inflation is down, the economy is good, and therefore it's likely a pause for the Fed now, and then rates down. That should push another leg or 2 up. I would not be surprised to see 5,000 points or higher in 2024. Also, reason why rates have to go down is the fiscal debt, or the total debt, that we'll discuss later. And you can see here the Fed's dot plot, what the market is pricing into stocks. Okay, 2024 a little bit down, then 2025 significantly down. Somebody is saying rates won't go down, someone is already seeing, but on average they all agree that over the long run rates should balance out at 2.5%, and that's the Goldilocks situation. That's the current Goldilocks moment. Everything looks great. The market is flirting with all-time highs. So nothing to worry about, and especially you shouldn't listen to Mark Spitznagel, who is the greatest bear, and it's his job to be a bear, but he's also surprisingly telling you to invest and be long, despite him being a bear, which leads to a very complex situation that you have to find the answer for yourself. And by sticking to this video, I'm sure you'll get there. However, also this positivity, now the market, if you look at 1 year performance, it is up 25%. So, as I said, everything looks good suddenly, but that's also a trap for investors, because investors usually do the wrong thing at the wrong moment in time. To go back here, people were mostly selling because stocks were going down on higher rates, but now everyone is very positive. Risky assets are going higher, the Nvidias, etc. And again, people are likely doing the wrong thing at the wrong moment in time. However, 1-2 legs up and then an apocalyptic crash is what Spitznagel predicts. When will that happen? It's impossible to know, but we'll discuss also the economy and how that crash that will likely come one day is absolutely in the making. And he says that this is the most dangerous time in the markets ever, not because of the Middle East or Ukraine. It has everything to do with what's going on with Washington. The Fed has created a tinderbox time bomb and the greatest credit bubble in human history. And I do not think anybody would disagree with what I just said. And when this credit bubble pops, then we'll see disasters in the economy, disaster in the market, disaster everywhere. Will it pop? Well, let's look a little bit at the data. But before looking at the data, let me just tell you that we can't do what he does, and he says also that we as retail investors cannot buy protection because it's most likely that we'll get squeezed out of our protective positions, then therefore also increasing the cost of that and lowering our long-term wealth. A perfect example of what he means is how Michael Burry, the shorting everything, the big short guy, is paying the price for shorting the S&P 500 and sold out his S&P Nasdaq trade puts for 40% loss. Now he's shorting semiconductor stocks. I think his biggest position is now the semiconductor ETF, and you can see how does that work. If we look at the puts for February 16, just took a chart there, it was 26 and those are already at 20. So it is about timing and also about not getting squeezed. We'll discuss more about that later when it comes to how to invest, but just buying put options and having a strategy, that's something that most of us are not simply able to do, because sooner or later the market will squeeze us. Also think about it, then you should have done something like this in 2011. The crash came in 2020, so you would likely have been squeezed out of the market, because when the crash will come is not predictable. But let's discuss the making of this crash, the economy and the Fed. Global central banks. If I say the Fed in this video, it's the same for all developed countries. And now he starts by discussing that we have been in a very distorted economy that led to distorted markets and have been manipulated by central banks. I think we all agree on that. We know that money has been printed, money has been sent to your post box where you could have just sat at home and spent that. And that has been done now in the recent pandemic, but money has been printed and rates held artificially low for the last 15 years. Therefore, we have now a market that's a 4, 5, 6x from the lows of 2009. That's a 6x market. That's a distorted market. And he says that we'll never be able to back out of what the Fed has done in the last 15 years. There is no turning back, and he uses this metaphor of forest fires and interventions in suppressing wildfires. This is a very nice metaphor, and when you think of forest fires, you usually see the big ones, but you never think of the small ones. And what is the problem here? Even if there is a small fire, in good intentions, of course, firefighters clear that small fire out to prevent bigger fires. But this also means that the grass, the logs, the old trees, the whatever, perhaps even tree species, etc., etc., don't get changed over time, which is the natural way nature has been behaving for thousands of years, millions, hundreds of millions of years, sorry. And then by cleaning out the small fires, not allowing them to clean the junk in the forests, you have these huge fires that are now growing in number and intensity around the world. And he uses that metaphor to explain also what the Fed has been doing, like creating a tinderbox economy that will explode at a certain moment in time. This is because monetary policy is the most destructive force in the global economy. To quote Spitznagel, it's taken a natural, healthy, homeostatic process, which is crashes, bankruptcy, recession, and then again growing, and turned it into something that is dangerous and destructive. This is what they've done in trying to eliminate recessions and crashes. They've created this tinderbox. And just think about it. Bankruptcies. Bankruptcies are there to weed out the bad businesses. Then better businesses replace those businesses. But if you save everyone, if you save all the car companies, God forbid to increase unemployment, you don't even motivate those people to find better jobs, etc., etc., which is the essence of capitalism. Capitalism is harsh. Communism is good to everybody, but it lasts only as long as it lasts. This comparison is mine, not Spitznagel's, but I have lived in both communism and capitalism, and now it seems I live again in communism. It's not much different, and I have some other things that I'll show you during this video. And let's just look. These gray lines are recessions, and you can see how in the past there was a recession every 4 or 5 years, a little bit longer here, then here, recession. And then since the 1980s, with low government debt levels because of higher interest rates, the government has been taking more debt and the Fed has been lowering interest rates, even going to zero and printing money here to prevent recessions. And when you don't have a recession for 15 years, everyone here has been saved, we haven't seen any crazy stuff during the pandemic, then you know you are in trouble when things start to go south, because then this monetary printing reverts, all the benefits revert, and then it is when it gets very, very ugly. Spitznagel defines this as a controlled burn, so you try to burn the weeds out, but just control as long as you can. But look at this very short period with significantly higher interest rates, and the Fed will have to start lowering those very soon. And Spitznagel says that the Fed can never truly let fires burn again. Even though the last year of rising rates was something like a controlled burn, but there's a limit to how much you can do that when you're in this sort of tinderbox. I think they're going to have to do an about-face and begin suppressing rates again. Right now they are spinning the story that they are going to be hawkish and that they care about inflation. But they are not going to have that luxury when the fire starts burning out of control. So much of this is the Fed just trying to talk its way out of this. But I think they all realize, and we should all realize, that there's no real good end to any of this. There's no real good end to any of this. If you focus on the now at the cost of the future sooner or later comes. What kind of scenarios? He doesn't even want to think of the scenarios, but we could go into a deep, big recession that reverts everything that has been done in the past, a depression, debt levels are high, biggest credit bubble in history. How do you solve a credit bubble? Well, if you have too much debt, then you print money. And as I told you a few times, I have been a billionaire a few times in my life because I lived in this inflationary environment twice. Hyperinflation comes there when you print too much money, and yes, I'm showing a stack of dollars, but I'm not the 1-minute millionaire on YouTube. It's just worthless money. So that's one way of doing it. The other is really to tighten, to cut entitlements, to cut pensions, to cut everything, to cut spending, and then slowly rebuild things, but nobody's going to do that. And when you think about what's wrong, Spitznagel is of the opinion that the world would be in a better place if the Fed had done less over time. There would have been bankruptcies, but bankruptcies are important. And bankruptcy and failure are really the key part of capitalism, what makes it work. And you know, in many ways, we've taken away that sort of homeostatic function of capitalism and markets, but it's not going to be gone. You're just going to see it impose itself later. That's really what these terrible crashes are. And we are in the greatest credit bubble of human history. That's the real problem. It is entirely because of artificial low interest rates, artificial liquidity in the economy that has really happened in a big way since the great financial crisis. And credit bubbles end, they pop. There's no way to stop them from popping. Debts need to get paid or they end in default. Of course, the debt burden today is at a level that cannot be repaid. You can just look at the total debt function of the economy. It's never been greater. And let's look at the debt. The debt globally issued on low interest rates has reached 140 trillion. This is the global bond market. This decline is because of higher interest rates, but the debt burden remains the same. 140, likely even higher with trillions. And that is why we are in the greatest credit bubble of human history. That's the real problem. It's entirely because of artificially low interest rates, artificial liquidity in the economy that has really happened in the big way since the great financial crisis. So a debt crisis has been solved with more debt. And credit bubbles end, they pop. There is no way to stop them from popping. Debts need to get paid and they end in default. And of course the debt burden today is at a level that cannot be repaid. Let me show you what he means by this. This is the United States total debt in percentage from GDP. And you can see here that now we are at 750% of GDP. 750% of GDP. I've just make a quick calculation. So 25 trillion GDP, let's say it's 7 times the debt. I think I took 6 times here just to round up a number. But that's already the debt double than what it was during the financial crisis. And let's say the interest rate is 3%. On 150 trillion of total debt in the United States, that's 4.5 trillion in yearly interest payments, right? However, if that interest rate goes to 6%, that's then 9 trillion, or if GDP goes a little bit higher, that's more than 30% of GDP when it comes to just interest rate payments. And when interest rate payments become a burden, bigger and bigger burden, it's not just that, okay, we can deal with that. No, it's about those interest rates not allowing for new investments. If there are no new investments, then less employment. Unemployment, the spending goes down, GDP goes down, everything goes down, and all the spiral that pushed the debt cycle up, the greatest credit bubble in history, all that reverts until we hit again the bottom. And that's what he likely agrees with Ray Dalio on the long-term debt cycle, that eventually it pops, and the bigger it is, the bigger the pain is later. And this is what is in the making now, and sooner or later the chickens will come to roost. When? Nobody knows. But if you look at this also, the gross domestic product in this case a log scale, if you look at a little bit, you can see here faster growth since the pandemic on even more printed money, on quantitative easing. But I'm just thinking, okay, if we increase this a little bit, you can see the faster growth here. If we then look at things and let's say those revert to something that should have been there without the money pumping and money printing, then we go from 28 trillion projected to 22 trillion. That's a 20% GDP decline. And that are the solutions that hurt. You can let inflation run. You can start tightening to readjust everything to a 20% decline. Yes, that is your new Tesla. That is everything that we enjoyed in the last 5 to 10 years, traveling, whatever. All those things get cut, and then you see a very, very ugly situation because it reverts and it overshoots on the downside as it did overshoot on the upside. So the Fed needs to lower rates to prevent the crash. If we look at what has been going on since the Fed has started increasing rates, S&P 500 earnings went from 215, they are down to the current 181. Interest rates have started to be a burden on the economy, on businesses. Less earnings, less business, less investments, less everything, and then you see these things revert. So if the Fed wants to prevent a crash, they need to lower that burden of interest rates that now is not yet there because interest rates on the money borrowed in the past are still low. But if that persists, higher interest rates, then it's going to be ugly. And the Fed will lower to prevent crashes because they are here to keep the markets high. And I was really surprised when watching this interview on Yahoo how the interviewer said that, okay, he is long the S&P 500 like most people. And I think that nobody understands Spitznagel or wants to hear him talk, because if most people are long the S&P 500, and then he says that there is an apocalyptic crash going forward, then you have to rethink your complete strategy, and nobody wants to do it now, especially not after the market is up 25% in the last 12 months, right? To give you some peace of mind, even Spitznagel says the Fed doesn't have any choice. The Fed is not going to let the market crash because the debt construct is such today that it can't let this credit bubble burst. And Jerome Powell will talk a big game saying how we gotta get inflation down and how there needs to be some pain, but they don't mean any of that when it gets to be bad enough that the Fed cannot afford to let the credit bubble burst. Because, back to my metaphor on forest fire, it will destroy the entire forest. Further on the Fed, he thinks that now the Fed is on pause mode, and that usually comes with a little bit of a Goldilocks zone, market up 25% as we have seen, but he absolutely thinks rates are going to be very, very low again because the Fed's gonna have to make them very, very low again to stave off what's coming. They've kicked the can and they are going to continue to do that. At some point, they're not going to be able to do that anymore, and I don't even want to think about what that means. And this is perhaps the most important of what he is saying. One day, when the Fed cannot prevent the market from crashing, there is either hyperinflation, which is extremely destructional to the way you are living. Don't think this is good. Yes, your stocks will go up in a nominal way, but not in a real way. Few businesses will do well, and that's an ugly part. Or the government will start cutting, or both, and then we can have stagflation, and that's something very hard to get out. But don't worry, there is also some good news, at least some. The question on the interview, written interview with the intelligencers was, you said this is the most dangerous time ever. Do you see any good news lately? Recently, sure. The good news is the economy is growing And that's the good news. Sorry about that. But it's a Pyrrhic victory. Almost all the good news with historic Fed intervention or monetary interventionism behind it, it's a Pyrrhic victory. You take victory now for suffering later. That's exactly what monetary interventionism does. It's giving you something now and you have to pay for it with a lot of interest later. Of course, that's what federal debt is too. It's our grandchildren's problem, not our, of course. And let me just explain what he means. The GDP of the US is projected to grow 2.2% this year, 2023, but 17% of it is government spending. If the government needs to borrow 1.4 trillion to spend these 17%, a quarter of that is 4.3%. Thus, GDP growth 2.2% minus 4.3% without looking at the multiplier there at all. That's meaning that the economy without the government borrowing would have contracted by 2%, which is a good, strong recession. But we prefer to borrow and give the burden to our grandchildren. Unfortunately, when asked whether there is a solution or not, the only way to get out of this is to tear the band-aid off, but that's of course something that nobody will do. There is not the societal temperament for that, so who knows, who the hell knows? He can't give you an answer on what the future will look like, because Powell has been talking a big game the past year or so, but it's all a big bluff. So we have discussed the economy. We know that the only thing I think as investors we need to know is there is the potential for a huge crash somewhere in the next 10 to 20 years. And if you know that, then you're already preparing yourself differently, preparing yourself to survive anything. And that's also the investment strategy, and that's also the investment strategy that Spitznagel promotes with everyone. Let's discuss risk mitigation, not diversification, so a little bit also there, and then how to invest in this environment. We can't do this, forget about doing 3000% while others are losing, because you'll get squeezed out. And now on risk mitigation, he's saying that diversification is not the way to go. So diversification is the costliest thing to do. There is no holy grail in investing, and you have to be very, very careful when you read any kind of data or something related to diversification. So they took Spitznagel, there's no really good end, huge crash going forward, and he says how diversification is not the way to go. And then if you read the Yahoo Finance article, then they say preparing for a crash, markets go up and down, blah, blah, blah. If Spitznagel's predictions come true, you do not want to have all your eggs in one basket, because that basket could easily go up in flames. Diversifying your portfolio with a mix of assets will help you spread your risk. But Spitznagel disagrees with it. He says that you need to actually attack, you need to be aggressive over your investment cycle to get to the long-term highest possible compounding rate. Diversification is actually diversification, and you are lowering your long-term compounding rate by diversifying. Because when it comes to risk, there is always the dilemma there when it comes to investing. Too much risk, too much leverage can get you wiped out, which is too much, but also too little risk is costly because it doesn't get you the benefits that investors taking risks have. And he says that it is better to mitigate risk by being offensive. Now, something very interesting when it comes to investing here in risk mitigation. He says that Berkshire, if he had to buy one stock for the next 20 years, Berkshire is a good one. But also the S&P 500 is a good place to put your money, because he is certain that in the next 20 years it will be higher than now, despite whatever we have now discussed. And this comes like a strange notion now. Sven, he's just saying to buy the index. Not that fast. He's saying that you have to understand risk as a path from here to the goal, let's say in 20 years. And that won't be linear. So you have to understand how much you can take when it happens, when the crash happens, how much dry powder you have to take advantage possibly of that crash, or not to get destroyed by that crash. Just more on canonical safe haven risk mitigation, diversification, hedge funds, bonds. It's not really risk mitigation, is a dilution of risk. So it's not allowing you to be more long, it's the opposite. So that's making you less long because you put 60 in stocks, 40 in bonds, and those that did that over the last 15 years with zero interest rates lost huge amounts of money because stocks did 6x, as we said at the beginning. So somehow along this path that he's described for the next 20 years, you need to find ways to having the dried powder when the moments come of greatest opportunity. A note on treasuries. Treasuries are not a safe haven. Treasuries are a hopeful haven. And as we always discuss treasuries, okay, you can park money now at 5%, but the real return long term will likely be 0% due to inflation. Those are pretty cheap now, as I said. If you want to park money, but as a strategic portfolio, just for temporary now, it doesn't address the non-linear nature of risk. And here we come to the first principle of investing, very interesting, discussed by Spitznagel also in his books, and that is that you want to compound at the highest rate possible. That is what risk mitigation will bring you. As when it comes to the first principle, you need to think of what is your goal as an investor. Your goal is to raise the lower level of your wealth in the future. So stocks go up and down, but in 10, 20 years, at the bottom crash, you want to have your wealth raised. If your wealth goes up, but then at the crash is lower, then you did very, very bad. So when you start thinking in, okay, I need to raise my wealth long term, then you have to find the compounding rate that will lead to the highest level no matter the crashes. So the key is not to raise your mean variance, what modern portfolio theory is saying, but your rate of compounding your average return. And the best way to watch this is to go to universa.net, Spitznagel's website, and there you have a wonderful video, the St. Petersburg Merchant Trade, explaining expected compound return, arithmetic return, and how the compounded return, even if lower, will lead to higher benefits in the future. Watch that video because it's the essence and beautifully made. So universa.net. I'll put the link in the description below. And when it comes to asymmetric risk and reward, if you lose 50% in one period, you got to make 100% in the next period. And that is non-linearity. And it gets worse and worse if you lose 60, 70, close to 100%. You need to make infinity to make it back. So that's the huge non-linearity when it comes to investing. You want to maximize your returns. And just to make a few examples there, if you invested 20 years ago in the S&P 500, 1 million at 8% per year would now be 4.5 million. But if you invested a little bit earlier, from 2000 to the low of 2020, your 1 million would be 1.7 million for just 2.7% per year. So if you look at those crashes and how those impact investing, then you see that you could lose half of your wealth, half of your compounding, just because of one crash. And you can think about diversification, but he is saying that that's a lie. There is no holy grail of investing. There is no diversification because all those that diversified got kicked over the last 20 years. And diversification is actually the cure that is worse than the disease. And what's then the best cure? The best cure is to focus on those big losses, because once you lose big, once you lose 50% of your portfolio, you need to make twice to gain it back. So think about risk, how not to lose that 30% of your portfolio. And then this is perhaps the most important part of this video. Ultimately, you need to think of risk mitigation not as protecting yourself from the markets, but more than anything else, protecting yourself from yourself, from the really stupid things that we all do. And this applies to professionals too. Look how short people have been this year. We have shown Barry at the beginning. Look how short people were last fall, how short they are right now, right or under invested despite stocks going up 25%. The markets make us do really stupid things, and we just need to set up our portfolio to protect us from doing stupid things. As Charlie Munger says, they just did not being stupid over the last 70 years, and that has brought them all the wealth that they have, Charlie Munger and Warren Buffett. So I think that this leaves us with fundamental investing. I have no idea what the markets will do, but if I own businesses that will survive whatever, and I don't watch stock prices go up and down, then I will be okay. Don't sell, buy the S&P 500. The question was from the interview there, the written one, where to invest? Of course, it's an impossible question to answer, but consider this. Consider what position you can hold such that if the market is down 50%, you will not sell. That is the core. What's that position? That's really the way you want to think about it. Buffett says the same thing. If you can't willingly take a 50% hit, you shouldn't be doing it. If you have a position right now such that a big crash is going to squeeze you out of it, then you shouldn't have it on. The market is going to do what the market is going to do. It's you who is going to screw yourself. So protect yourself from yourself. Project yourself into environments that are both scary and euphoric. Think what would you do. We're probably going to see both in the next year. Two wonderful opportunities for the market to make you do precisely the wrong thing. So when it comes to how to invest, if you can't willingly take a 50% hit, you shouldn't be doing it. That's the core of investing. So think about it. Think about what you own. Can you survive a 50% hit? If you can't, then you're in trouble. Fortunately, you still should have a few Goldilocks legs up, a year maybe 6 months, to structure your portfolio in a way that if a 50% hit comes, and here and there it comes, you survive it. That's the key. If a crash is going to squeeze you out, you shouldn't have it on. Think about it. If there is a crash, will the bank squeeze you on your real estate property? Will the bank squeeze you on your margin? Will this? Will that? If you can sleep well with crashes coming, perhaps it won't happen, perhaps it will happen. Perhaps the possibility is not something that we as retail investors can risk. We need to know that we will do well over time. So prepare your portfolio so that you don't get squeezed. Protect yourself from environments that are both scary and euphoric. I'm looking at the S&P 500 and we are now 25% up, thus people are euphoric. But people were scared a little bit here. Here, many sold instead of buying. We were buying here constantly, did well there, and now, okay, this is the S&P 500, the only index that's going up. There is a lot of down, so we have already started buying. But if you just look at the euphoria out there, Janet Yellen isn't worried about the 33 trillion national debt. That's because now interest payments are 2% of GDP, and since 1960, those were just under 2%. Of course, then interest rates were 8%, now interest rates on the debt are 2%, but when those interest rates in 5 years become 6%, this will be 6% of GDP, and that will be a disaster for the budget and government. And then you think, okay, this is Janet Yellen, and she is the United States Secretary of Treasury, and the only reason she is paid is to tell you this, to tell you that she is not worried. She should be worried about not being here in 5-10 years, because that's nature, and it's also nature that when this goes from 2 to 6, there will be a lot of trouble. Then I was just answering some comments, And this was a recent comment on Beyond Meat. And we made a video, I think in 3 June 2021, time flies by, when I said that you must be beyond sanity to invest in Beyond Meat. And since then, 95% down. But when I'm looking at the market, there are still many of you that are in this euphoric investments that will change the world, that is still holding on in some things. That's a very, very risky place to be. So I have summarized this in a few questions that you have to write down the answers. Let me know in the comments. Can you take a hit of 50%? I think I can. Do you have the dry powder to take the advantage? I think I can from my personal income, dividends, and perhaps even something should give me an advantage if there is a 50 market crash in my portfolio. Am I afraid of any squeezes? No leverage, no one can take anything from me. So that's something. And whatever happens, does my life go on? Whatever happens, I can turn on the light. Of course, if I have internet, I can make YouTube videos, I can share my work online on my research platform, and I should survive. I also know how to fish, I know how to make my own food. Spitznagel has his own farm of goats. So these are my answers. And if you don't have these answers, then you are not on the path to continuing accumulating wealth no matter what happens. And I think this is the message, that you can think of wealth in money, in currency, but currency is going to zero. The dollar is going to zero. Every other currency is going to zero. So the only way we can have more wealth in the future is to compound value, to compound businesses. And that's what we are trying to do by focusing on fundamental investing, buying more and more of wealth, of value that can compound over time. It was a long video, but I think this video is an essential video on how to invest in the next decade. Thanks for watching. Check what I do on my research platform. Now is the best time to join, just before the crash. Yes, because we are there to protect long-term wealth. I'll see you in the next video.